Deloitte Tax. Welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. And today we're going to be discussing how active involvement of tax expertise can significantly influence a variety of business areas, from enhancing financial strategies with tax credits and incentives and to managing ESG-related risks in M&A transactions. Joining me today are three Deloitte specialists in the area of tax credits and incentives: Carl Obradovich, Linda Benelli, and Kate Asai. It's really nice to talk to all of you today. And to get us started, Carl, I'll start with you. The IRA has introduced some significant changes to tax policy. We've talked about them a bunch of times here, but particularly in the renewable energy sector. So how do we see this legislation shaping tax planning for businesses in the coming years?
Hi, Carrie. According to a Deloitte 2024 CXO Sustainability Report, 85% reported an increase in investment in sustainability, signaling that companies have shifted viewing sustainability as a compliance brand building exercise to viewing sustainability as a driver of new products, new business models, and value creation that can create competitive advantage and continue to drive innovation. Legislation such as the IRA and CHIPS Act have provided a funding mechanism for companies to increase investments, which will enable them to enter new markets. And Kate, can you share your experience from an M&A perspective, how investors increasingly value companies with a strong sustainability focus?
Yeah, I think an important feature of the IRA is businesses that previously couldn't benefit from tax credits can now transfer or sell those credits, which in turn really unlocks liquidity. And I think any business with a tax liability needs to be considering the benefits of renewable investments and what kind of return on investment can be achieved through strategic tax planning. So with transferability, your ROI is determined through the purchase of tax credits and a discount from their face value. And these credits can be considered for estimated tax payments to accelerate the recognition of the cash benefit. But that obviously needs to be timed appropriately. And cash payments can be negotiated to align with estimated payment dates, but the tax credits can't be used to offset estimated tax payments until the documents are executed and tax credits are probable. So I think it's really important for diligence and planning to be part of that discussion, and if that's a strategy that a company is going to pursue. And then with traditional tax equity, return on investment is earned through an allocation of tax credits, taxable losses, income, some kind of disproportionate distribution of cash, and then maintaining a residual interest in the project. So that's the classic tax equity structure that we've seen in the market for years, but I'm seeing it adapted where tax equity investors are further transferring tax credits to third parties and hybrid structures, which again is just another lever for monetizing these tax credits that may otherwise go unused. But again, it just depends on kind of the type of sponsor or buyer you are in the market and which tax strategy better aligns with business needs.
And let's get you into the conversation. What are you seeing businesses do to strategically leverage credits and incentives to reduce costs as well as enhance financial performance?
Thanks, Carrie. And as Kate said, there is a significant amount of activity in this space. And what we're seeing really differs from organization to organization, but credits and incentives and tax departments are much more integrated with strategy, with broader business decisions. Things such as the location of a project can really make a significant difference in terms of benefiting from these opportunities that Kate and Carl were just mentioning. So the IRA has things such as economic community, and being in an economic community can really enhance your benefits versus not being in one. So location's going to matter, tax departments being in that discussion, having the business think about location in terms of maximizing some of the benefits that are available under the IRA and general state and local incentives. Distressed areas always tend to be areas where a state and local government is going to be a little bit more willing and a little bit more able to be creative and help organizations invest and bring new jobs to that area. So the benefits that the tax team is really bringing, it's a little bit unique where before it would be reducing a tax liability. Now it's got opportunities from a true cash flow perspective. Being able to monetize and transfer these credits changes your cash flow and your perspective on some of the tax credits. And there's significant opportunities for grants under the Inflation Reduction Act. There's significant opportunities to layer on some of these benefits. So as organizations are considering new investments, really having the CFOs, your sustainability leaders, and the tax team all at the same table really is the best approach that we've seen to maximize your benefits.
So Kate referenced the transferability of certain renewable tax credits under IRA, and that seems very advantageous. But are there any challenges that companies face regarding the transferability of these credits? And how can they analyze whether these credits will retain their value post-acquisition?
The buyer steps in the shoes of the seller as if they generated the credit. There are certainly risks that are potentially there with any purchase of credits, including investment tax credit recapture, credit worthiness of the seller, and audit compliance. But there are ways for buyers to mitigate the risk, including ensuring that there's indemnity clauses and tax insurance. The buyer can request a tax opinion or formal memorandum to better understand their tax exposure. And they should ensure that they're receiving the required audit documentation, even if the seller will ultimately control the audit. Kate, as a partner in M&A practice, you're no stranger to tax diligence. Can you talk about how diligence should be performed for these transactions?
Sure. I think at the core of these transactions, acquiring tax credits comes with risks. So transferability risks that remain with the buyer and a seller. And so tax diligence should really be performed for these transactions in the same manner as typical M&A transactions are. I think the focus of diligence efforts that I've led recently have focused on tax basis for ITC transactions. So there's this perceived risk associated with investment tax credits where buyers bear the risk of recapture and extensive transfer as a result of the seller taking a basis that the IRS later determines maybe was not appropriate. And so step up in ITC basis and the associated risks, diligencing like the valuation reports is pretty critical component of diligence. And I would say secondary is prevailing wage and apprenticeship compliance. So if a technology is not grandfathered and a project has to comply with PWA, understanding the documentation that's going to be necessary to support PWA requirements is going to be essential. And then lastly, I would just say if the technology is new or novel, so projects that are claiming 45X, 45Z, credits that aren't necessarily related to solar and wind development, I think the diligence landscape is also changing. So it's important to make sure that tax diligence for the credit qualification is being performed.
IRA certainly made transferability a hot topic, but how does more traditional tax equity and M&A structuring for renewable energy investment factor into the current landscape? And what tax considerations should a company take into account when structuring deals?
So I think while we're expecting a dramatic increase in transferability transactions in 2024 and into 2025 and beyond, I do think tax equity is here to stay. Because of the economics, because of depreciation, monetization of traditional tax equity is going to still remain relevant even in a transfer market. And as I mentioned previously, there's these hybrid structures that allow for a 99% Class A member to flip and transfer a portion of credits. And this type of structure is still going to allow for depreciation to be monetized. There's the benefit of working with a tax equity investor, like a bank, who's still going to do a full underwriting of the project, and that kind of diligence that the tax equity investor is doing can really be passed on to the transferred credit. So buyers of a credit that's coming from a tax equity partnership that can benefit from the diligence that's already been done. And I would say these structures are not without risk. So I know there's been circular cash concerns, and these structures or hybrid tax equity structures are certainly very fact specific. So I'd stress that having the right tax expertise is paramount to considering any kind of alternative tax structures or these hybrid approaches.
Right. Well, let's zoom out to wrap up here. What are some of the common pitfalls that a company should avoid when managing their tax credits and incentives during the M&A due diligence process?
So, Carrie, I'll start with this, and Kate would love to hear your thoughts on it as well. But what I've seen is really a lack of maybe the proper due diligence up front. And Kate, you could maybe talk a little bit more about that. But I think one of the keys, and especially one of the great benefits of doing due diligence, is getting that documentation and having a comfort level to make sure that you have the proper documentation. I think that the transfer from a federal perspective is really new territory. And so these tax credits can get challenged. You're stepping into the shoes of the credit producer. And in having that different twist versus what, Kate, you were talking about, the credit investing, this is a little bit different. And I think really a pitfall is going to be making sure your documentation is there to support any risk or any claims you may have for recapture, and making sure that you hold that documentation because you will be the one supporting it on audit with the Internal Revenue Service. So, Kate, what's your thoughts around that?
Yeah, Linda, I completely agree. From the M&A side, the market is just increasingly competitive with many new buyers coming into the market and participating in more rapid transactions. So sellers really just need to be prepared with documentation to support the tax credit being claimed, just like you were discussing. And I'd say deal size and insurance just continue to play a dominant role in market pricing. These are large transactions. The audit risk just needs to be considered because a buyer will be subject to an audit, but a seller is typically the one that possesses the relevant documentation to support these credits. So it's really important to have some level of due diligence to obtain that documentation.
It's so true. And one other thing I would mention, Carrie, is on the state and local side, there's a lot of uncertainty on how these transactions are going to be viewed. As you know, a number of states don't follow the Internal Revenue Code. And as such, you do want to take a step back, both from the buyer side and from probably the seller side. A little bit more important is to how the states are going to view this transaction. For federal, it's clear, and this is, it's not going to be reported as a gain, et cetera. Yet on the state and local side, especially your larger states, the Californias or the states that don't have an income tax, like a Texas, those are states you really want to pay attention to and to make sure you understand how the transaction is going to be reported, both in your base and your apportionment.
Lots to think about. Thank you, Linda, Kate, and Carl. And as always, thank you to our listeners. If you'd like more information, just go to Deloitte.com and search on IRA credits. There's a lot of broad information there. As always, I hope you will join us next time, and I hope you all continue to live well. Take care, everyone.